Good afternoon. This is Al Espinor of Century 21mm of Stockton, California. And today I'm going to share with you a topic that I know keeps coming up and up. And I get this question a lot from my clients and from prospective buyers. And it's called, how do you determine the interest rates? So what I thought I'd do today for the benefit of everybody is to kind of just break it down, how interest rates, not just mortgage rates, credit card rates, auto rates are determined. So let's take a look and see how this comes about. So we're going to take a look right now at my screen. Let's see if we can get it opened up here. I'm going to share this. Okay, so how do interest rates work? So we're going to start by the first thing. How many different factors determine what you end up paying for in interest to your lender? So a couple of things come into play. Number one, credit FICO scores. Most lenders will look at the average of your 3 credit reporting scores from the following 3 credit reporting bureau agencies. First one is Experian. The second one is TransUnion. And then you have Equifax. Now, most cases, each lender, bank, credit union might look at one of the 3, but what I do know is that on average, they'll take all 3 of your credit scores and average it out. And what that amounts to will be your final credit score that they'll base your credit standing on. Obviously, it's really important. Paying your bills on time is a huge factor in part of the factor in determining getting the best interest rate. Next, of course, the lender's going to look at your income, overall monthly, annually. They'll usually base it on the last 2 years of your federal tax returns. They're going to look at the length of time on your job. Most lenders today want 2 years or more on the job just to show that you're stable. And then, of course, they're going to look at income to debt ratio. So basically what that means is what you earn per month divided by what your monthly payment obligations are across the board. Your rents, your credit cards, auto loans. Obviously, the less you owe, the better your ratio will be, the lower it will be. If it's the opposite, then the higher it'll be and might pose a credit risk to the lender. And then they'll also look at what you have in your savings, 401k, retirement, bonuses, and other sources of income. So those are some of the determining factors that lenders look at. Next, we go on to how do banks and lenders set rates. Now, this is the one that everybody's been asking about, especially since about less than 2-3 weeks ago. The Federal Reserve said that the rates were 0%. Obviously, a lot of people got confused with that and thought, oh, my rates should be 0%. Nope, not exactly. Let's see how it works out. So banks and lenders consider different factors. And of course, they look at financial markets and what the Federal Reserve determines to be the standard. So the first one is the federal funds rate. That's the one we heard about on the news, 0%. That's actually the interest that the Federal Reserve Bank, aka our government, determines to charge the banks in order to borrow money and to, of course, make loans to the general public, which is us. Next, you have what's called the prime rate. Now, the prime rate is what consumers like you and I pay for short-term loans or personal loans. For example, prime rate determines credit card rates, adjustable rate loans, equity lines, personal loans, auto loans, mortgage rates. Now, mortgage rates are a little bit more complex, so I'm not going to get into too much on all the details, but what I can tell you in general terms, they're different depending on either the treasury bond market and the secondary markets. Most mortgage loans are packaged into what are called MSB, mortgage-backed securities, and sold off to investors. Now, right now in today's climate with low interest rates, there's a high demand. It's also supply and demand. So the more people want to refinance, which obviously there's a lot of refinance going on, and buyers, first-time home buyers that want to buy a home, the demand necessarily can affect the rates, not necessarily to make it lower, but to actually go up a little bit higher. So if the average rate right now were 3.56, which is pretty close, the lender might charge you 4%. And that all has to do with supply and demand, okay? That's one thing I wanted to make sure that everyone's clear on. So how do you get the best rates? Well, position yourself by having as good credit as possible. 2, shop around starting with your own bank or credit union where you already have a relationship with. 3, compare loan programs side by side. 4, try to have a good down payment. That helps. And then 5, finance as shorter term as possible. So shorter term is less risk for your lender, which equals better rates. So just to kind of summarize, these are some of the things that you want to look at when you're shopping around for rates. And, you know, again, there's a lot of different places that you can go for these resources. But again, start with your banking institution or credit union. And then from there, you can shop around and see what else is out there. Okay? So this is my tip for the day. And I hope everybody out there is doing well and is safe. And we'll get through this together. Whenever you have any needs for real estate, contact me, Al Espinor Jr., Century 21 MM. Also visit my page, Century 21 MM, Homes by Me and You. And also subscribe to my YouTube channel, Century 21 MM, Al Espinor Jr., GRI. Please hit and subscribe for more updates and information and fun things like the cooking and interviews, okay? I look forward to talking with you soon. Take care.